Hello, folks. Brandon Chapman with you today. It's another edition of TheoTrade video for Monday, September 12th, 2022. So the day after September 11th. Man, things have changed over the last, over 20 years now. But hopefully reflect on the unity, I guess, we felt after 9/11, and hopefully we can kind of rekindle some of that. That seems to be lost a little bit. But as we think about the market, dollar weakness really propels stocks higher, but what's next? We're going to look at a survey from Deutsche Bank. They may give us some clues as to what market sentiment is. But man, it's a wild market, not so much in volatility, but where are we going, right? That's when we talk about the wild nature of it. There's just so much uncertainty. Hopefully we'll kind of add to maybe that certainty or direction or opportunities to play. Now, as we look at the S&P, we were about 1% higher today. Looking at the sectors, you'll notice energy bouncing back up nearly 2%. It makes a little bit of sense. I mean, you have the fundamental story of very undersupplied energy markets. That should, in large part, contribute to holding up prices. The only problem is we do have a demand problem, or potentially a demand problem building. And so where do we end up going? Do we see the curtailment of demand just through high prices and a pullback in a consumer and recession that may cause oil prices to decline, whilst on the backdrop we're relatively undersupplied? And this makes it very dangerous, because if we see a crush in demand and prices go down for oil, this is a futures, crude oil futures. If the Fed starts to ease again, you'll probably see this really start to run higher. And so we're really going to have a hard time getting out of the box. And so any downward movement at this stage anyway, it's probably going to be a relatively slow grind. And so maybe hard to trade to the downside. The curve is flattening here a little bit. This is the current, futures curve for oil. It's pretty flat as we move from the current contract to the next, the active to the next contract. This compared to, for example, on August 29th. So again, we're flattening, we're diminishing, but we're still in backwardation, meaning what? Meaning the line's declining here. The risk is still to the upside, right? It only takes maybe, that wet banana peel moment, in that you step on banana peel in terms of supply, maybe it's a conflict, etc. It could send prices spiraling like we saw last year. We're probably in a little bit better supply position in the United States compared to maybe February, when prices had gone up dramatically before the Ukraine conflict here. But again, the one foot on the banana peel story just suggests the risks are to the upside if anything happens to supply. But if supply remains relatively stable, as long as OPEC doesn't cut, maybe we grind our way down here to about 80. But there is kind of a terminal level, probably not at 60, where oil will settle in. And I think that's what you're seeing over the last couple of days here. We dipped to about 80. They're coming in and filling here, basically suggesting this $80 to $90 range, maybe as low as it gets. We might hover there for a while. There may not be a whole lot of upside, but we may start to see more stability, or the price starting to form a base around 80 instead of like 90, like it did, for example, back here, 90, 95. So top performing sector, and you got technology. That makes sense with technology. There's a lot of short interest there. Cyclicals, there's a lot of short interest there, meaning what? Those are some of the more heavily shorted parts of the market. And of course, I have my high short interest watch list in here as well. And we'll just go greater than 5%. I don't update this every day, but you saw last week some bullish activity starting to percolate, call activity in stocks like, Plug, for example, or other more, in the EV space, for example. Neo today up 13%. They just lost $1.34, by the way. Never mind, right? We're moving higher. The real, this discounter space is kind of interesting. We had previously seen some nice call activity back here in early August, got a nice pop out of it, then we eased back to support again. Now we're coming off of support, but again, real is kind of a discounter, right? Of name brand and luxury kind of apparel and other stuff. We also saw some discounter type bullish option activity today in stocks like Overstock, for example. Overstock, it was on the September expiration right here, for example, out here at the $30 strike price. And again, maybe some rolling going on, et cetera. But the idea is that, again, you're seeing this kind of activity. We pegged 31, and we start to break through it. It creates additional gamma, possibly a gamma squeeze, but also Overstock has 16% short interest, 4.3 days as far as the cover. So the chances of us retesting prior highs seems pretty reasonable towards that kind of $35 price point. Could we squeeze higher than that? Absolutely, we could. But is this the same as what we saw in June when markets went soaring? That's a hard thing to tell. I mean, are we basically seeing the squeeze and we're going to rip lower again? Or are we going to see the squeeze and a continued squeeze for several weeks? We'll kind of look at that here in just a second. But also other discounters today. For example, Dollar Tree, DLTR. Dollar Tree had a big gap down on its earnings. The pre-announcement back here, and the earnings came out, shot it back up again. But could we bottom in this area and maybe look to close the gap? Well, if we look at today's trade in Dollar Tree, again, this September expiration, again, they're really hitting the area where there's probably the most potential gamma impact. 150 is the strike price that was traded. And again, mostly bought. We start to take out 150, we may see it propel the stock for it to close the gap. This is also more of a non-cyclical type company as a dollar store. So again, the discounter space seeing a little bit of a flow of activity today. And, last Friday, it stocks like, Nordstrom, for example, JWN, others, last week, you just saw this kind of attempt to push these high short interest names. You start to see that build last week, which makes sense. It's been successful before, hoping that it's successful again. Another name in this bag is FUBO. So Fubotv. If you look at the activity in FUBO today on the September expiration, I'm kind of more centered to this 550 strike, but you can see it across the board here. A lot of it may be turning over intraday, buying and then selling, intraday trading, and generating that kind of interest. But if we start to see a lot of this carry over to open interest, meaning it was held into the close, these levels start to increasingly become more significant. $5.50, $6, and it may, as we break those levels, push the stock higher. The upper end of that shadow is about $8. Now, when you look at the option implied volatility here, we'll go to a next week expiration. What you'll notice is that because of the high short interest in FUBO, notice the volatility is rising out here. What's happening is you're buying calls as a hedge, selling some puts in here, suppressing just out of the money puts, accentuating the implied volatility in the out of money calls. This does create a nice skew to speculate. So if you're looking for that lottery ticket kind of trade, what about a 5 to 7 here? You buy the 5, sell the 7. It costs you maybe about 32 cents or something. And for $2 of upside, minus 30, that's $1.68 of upside for 32 cents of risk. So, again, if you're looking to speculate, you could do that. You got 11 days for this thing to pop. And if it does, it could pay out very, very well, as if that 7 starts to go in the money and it tests the prior high here. So low probability trade, but it is one where you're seeing option activity come in. It does have high short interest. We're seeing bullish movement. So all we need is that little bit further squeeze, and that could easily take it higher and significantly higher in a very, very short period of time. But you got to be in ahead of it, or sometimes you catch it here and maybe you catch part of that move. But again, right now we're seeing it into the move a little bit, but we're looking to see maybe going to $8. Let's circle back to some of the markets. So the point being is we go back to the S&P. Could we continue to squeeze higher? Sure. Right? We're at the 50 en route to maybe a 61% retracement at about 415, 416. But one of the ways to look at it, are we starting to see kind of a terminal end of this, is by regarding the VIX. The VIX actually moved higher today, right? So we look at the S&P. The S&P moved higher. The VIX, however, also moved higher, which is fairly unusual to see. If we look at the back month volatility, we're looking at the forward premium here. I got to bring up a ratio of the two. We're going to bring up the Paris ratio study. You'll notice we actually ticked down today. So despite the rally, back month volatility dropped relative to front month volatility because the VIX rose. They didn't sell it. So that actually helps this move kind of stay on the table here, where the 3-month VIX is only 6% above the 30-day VIX. As we look at skew, we can see where we finished on Friday. We ticked mildly higher here to 120. So, you would have thought that today's bullish move, it should have seen the market probably see that curve steepen and start to point to a decline. Instead, they didn't. And so it just suggests that we may have just a little bit more to this rally. And this is a point where you've got to start to look at maybe some of those short interest names that may continue to move with the market. Also, you look at the top performing sectors today, right? Stocks on the S&P 100. Apple's in there, right? If the market's going to go higher, Apple should participate. Amazon should participate. These are ones you can jump on board a little bit in anticipation as the market rolls higher, that those should perform well. Another note to show here, right? MDT, right? BMY, huge gap and then faded. Gilead, huge gap today as well. We are seeing some rotation into healthcare. So we go back to our spider sectors here. Go the right one. There we go. XLV was not the best performing sector, but in the big cap space, it was with a lot of healthcare related names. Thermo Fisher. So again, you are seeing kind of a defensive positioning. Even utilities were up here, despite the fact that treasury yields are rising. 10-year yield rising. TYX. The yield is rising. FVX. Where is the Fed going to stop in terms of interest rates? Let's circle back to a Deutsche Bank survey that was released today. Ask the question, 4,500 or 3,500, which is more likely? 74% of participants in the survey suggest that 3,500 is more likely than 4,500. So again, I mean, you think about, we got, 400 points to the upside. We've got, 600 points to the downside. Again, right now, the bearishness is very similar to what we saw back here in June during the survey. So do we rally from here? Well, we're probably in a little bit different position. I'm not sure when they did the poll here in June, but there was a very dour outlook. We saw the big rally. We've seen the big sell-off here, but at least right now, as we're kind of inching towards that 61% retracement, 74% think that we're probably heading down to 3,500 more readily than 4,500. Are we near a bottom? 10% suggested we're bottoming here or have bottomed already. 58% suggests we're going to find our lows maybe sometime in 2023. A 5-year, 10-year treasury yield. So we look at the TNX here. We're currently at 3.3%. A 5% 10-year would be just crazy in terms of what the impact that would have on corporate earnings, on the deficits. We're talking about 73% now versus 60% in June. People are raising their expectations in terms of where interest rates are going. We're currently seeing mortgage rates at over 6% and recession. 80% see recession in the future here. So, some might look at it and say, yeah, but everyone's priced it in, and the market is poised to make a big rally here. The only problem I would say with regards to that is that the one thing the market is not really pricing in is the likelihood of a major default in terms of consumer debt, mortgages, corporate bonds, etc. The pressure that we're seeing right now in terms of treasury yields, this is going to have a very, very direct effect on earnings. And as we're looking at what the Fed is expected, we got a CPI print coming up tomorrow. We got PPI this week as well. The track of the Fed right now looks like they are going to raise more aggressively. So you look right here, for example, we're currently at 2.25% to 2.5%. We're talking about a 1.5% move in interest rates by when? December 14th. 25% chance of maybe close to 1.75%, right? So we got 1.5 pretty much on the table to 1.75. And if you look at where we were just a week ago on some of this stuff, certainly 3.75 of 4%, pretty similar to last week. From Friday, significantly higher than a week ago or a month ago, right? 4 to 4%. Now we're talking about 4 to 4.25. Big change from just a week ago, right? It looks like we're starting to angle towards 4% being on the table. Is it right that the 10-year is going to go to 5%? I think it's going to have a hard pathway to get there. But again, there are those out there that are looking at this and saying, hey, we're going there, right? It looks 38% for February. And man, you start to add this stuff up, similar to what we saw a day ago on Friday, but substantially higher. But you do see kind of a leveling off effect here. What you don't see is you don't really see the pivot, right? You just don't. We got over 50% probability by March we're going to be at 4 to 4.25%. What about if you go out to July? 4.25. July, maybe we start to see what? Maybe, but it's not. It's very, very slight here. There's virtually no pivot from 3.75 to maybe 4.25. This range here, there's virtually no pivot being currently priced in for next year. And that has to be disappointing, right? The higher the yields remain and the longer they do, the more debt the corporations are holding on to, where they have to roll in at a higher yield. The potential here for default is going to escalate. So while sure, we could see a continuation in this rally, the bigger picture is very, very hostile for stocks. And so while we might think the market could continue to make a little rally here, and certainly the volatility markets are indicating that as well, be prepared and maybe start to look at opportunities to begin to take some downside shots. HYG, for example, just a simple in-out spread, buying an in-the-money put, selling an out-of-the-money put for October. We could very readily see a sell-off going into the fall, and this could end up down here at lows again. Anyway, so, other things like, real estate. Big move in the last week in real estate. If yields keep going higher, we're going to see this continues. We're going to start to see pressure. It's a very interest rate sensitive part of the market, heavily leveraged, et cetera. We could see this break down again. Chinese companies have seen a little bit of a boost of late, right? KWeb, the last couple of days here. Big activity coming in today on KWeb. The September expiration this week at 27.50. Again, buying puts at this level. We start to break support. We could see this readily roll to 24.50. FXI today as well, right? At the for it's the 28.50 for September. So again, very short dated this week. But man, you start to take out the lows. There's the catalyst to see the gamma kind of escalate with the gamma squeeze to the downside. So those are a couple of stuff to watch for downside potential opportunities. Another one that's a bit surprising today is FCX. This is one, again, it's in the metals space, precious metals, copper, et cetera. Big move over the last several days. We're kind of hitting up here, and all of a sudden today we kind of faded from our high. At the same time, we're seeing some bearish trade come into FCX here on the downside. The 31.50 for September. Again, out here in the 30 September expiration. Again, down here, a downside spread at 31.50.28. And so the fact that, metals had a pretty good day, if you look at GLD, for example, gold was up 0.5%, silver up a lot more, almost 5%, /HG, copper up about 1.3%. You'd have hoped that FCX would have gotten more movement out of it. It just didn't. And we're kind of, looks like we may be stalling here, looking to retest our lows again in the near term. So if you're long FCX, this may be a time to start to look to take profits. But some of the gold trades we talked about last week, I think last week I talked about core mining. It's a longer dated option. It did fade from the highs today, but it was up 6% today. Over the last week, it's done pretty well as the dollar has weakened. And of course, on that note, dollar down about 0.5% today, predominantly against the euro. So again, the euro / US dollar breaking out today as well. There was some bearish trade coming into UUP. And if we look at the trade tab here for UUP, this was for a 14 October, a couple of them actually, right here at the 28th strike. We had a 7 October out here at the 28.50. So as we look, we're looking at the downside, 28.50, 28. Again, we're looking at maybe the dollar testing down here. And that's probably the one near-term bullish case for stocks. If the dollar continues to sell off, that helps prop things up. Can help stocks like Apple, other things that are going to track the S&P 500 or be the drivers for the S&P 500 as we go run back towards resistance up here. We'll watch the volatility markets to see if those start to point to more downside. But right now, high short interest names, stocks that are going to track the market pretty closely are the ones to maybe look on the bullish side. Looking for bearish setups in some of these other ones as well. Agnico Mines was on last week as well that I talked about in one of my sessions. But again, these are moves in gold. There may be a little bit of juice left in these tanks if the dollar continues to sell off. That pushes stocks higher, generally speaking. But again, maybe a little rotation today towards healthcare and staples as well. I'll discuss this when we wrap up. CLX today at resistance. This is probably an area you might use as some sort of trigger, but it was a SEP 157.50. So if we start to take this out, we start to break higher, we might look at this thing retesting prior highs this week if we can get the breakout above today's high. Anyway, we'll wrap it up there, folks. Hope you have a great one. We'll see you back next week for the video. Have a great one. Thank you.